As we approach the end of the year for the S-Corp owners, S-Corporation owners, you know that you should be paying yourself a reasonable compensation in W-2 wages throughout the year. But what happens sometimes is some business owners take draws throughout the year where they're just writing themselves checks, and then at the end of the year, they need to run a payroll for themselves in order to reclassify those draws to W-2 wages and also pay appropriate payroll taxes. So if that is you, what I'm going to show you how to do today is I'm going to show you how to run a payroll like this using Gusto. You can do this with other payroll providers as well, but I want to show you specifically with Gusto because I have a demo product that I can show you and show you how this works. So I'm going to show you how to do that, and then I'm also going to show you what the financial statement impact of doing that is. And so we're going to get into that. I'm going to do a screen share in just a second. Before we get into that, I want to do a little bit of explaining about how this might happen. So I just had this happen with a client where they recently, as of like maybe March or April, they made the election to become an S corporation. So, or be taxed as an S corporation. So they're an LLC and they made the election with the IRS that they would like to be taxed as an S corporation as of January 1 of this year. January, February, March, April, May, June, July, August, September, October, November, and December draws were taken because that's what the business owner was always used to doing. And she did not want to get set up on payroll right away because of some cash flow up and downs. And we said, hey, that's fine. We will do an adjustment at the end of the year. We knew that we were doing this. This was very intentional. We are getting on regular payroll in 2025, but because she had always been operating this way, it took a little while to get transitioned over to actually paying herself a payroll. But one of the things when you elect to become an S-Corp, you need to pay yourself as an owner what's called a reasonable compensation for the work that you're doing in the business. And this is very important because the IRS says you need to do this, pay yourself a reasonable compensation, because they don't want people paying themselves very, very, very low W-2 wages and then getting the tax benefits of not having to pay self-employment tax. And there's reasons that you do want to pay self-employment tax too, or you want to pay that other portion of the employment taxes like Social Security and things like that, because it does help you in the long run. But people are always trying to figure out ways to avoid taxes, and that is one of the major tax schemes, is to become an S-Corp, pay yourself a really low W-2 wage, and then take a ton of draws on top of that. But that's not right. So if you were to get audited and you're doing that, you would be in big trouble, and then you would be getting penalties and fines for the wages you did not report correctly in previous years, okay? So what I wanna do is I wanna help you get it right as best as possible. So the first thing, we're not gonna go into everything about reasonable compensation. That will be a different video. Very, very quickly, the idea of reasonable compensation is that for the work that you do as a business owner, what could you pay someone else to do the work that you're doing? Or are you being paid appropriately for the tasks that you're doing? Okay, so that's kind of sort of saying the same thing. I mean, reasonable compensation, it's pretty self-explanatory. So if I'm spending all of my time in really high-level tasks that only like a very well-educated, like very efficient person could be doing, then my reasonable compensation should be higher than if I'm spending all my time cleaning the floors, because that would be more appropriate to a janitor's compensation. So we need to think about what you're actually doing in your business, okay? A lot of business owners will say, well, I couldn't pay anybody to do everything I do for my business and still afford to pay myself anything. Yes, I 100% agree and understand that concept, and we will get into that on a reasonable compensation video later on down the road. But there is a concept called the many hats approach, where you can basically come up with a calculated number that says, well, 10% of my time is spent as a janitor and 15% of my time is spent as a marketing person and a marketing assistant, and then 30% of my time is spent as a CFO, and blah, 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 blah. So you can kind of piece together what could become a reasonable compensation. And there is a fantastic tool that can help you do that called RC Reports. It stands for Reasonable Compensation Reports. I will put a link down here to that. That's Clara CFO /RC Reports. We are an affiliate with RC Reports because they are the best place to go and do that calculation and be able to figure out what your reasonable compensation could be. But again, we're going to get into that more in detail in a different video. This video is kind of assuming you understand reasonable compensation enough to know that you need to pay yourself more W-2 wages than what you have during the year. What we want to do is we need to take some of those draws that you had during the year and transition those, move them over to be gross wages and to be W-2 wages. So what I want to show you first is I want to show you a set of financials, and we're going to hop into that. I'm going to show you real quick what that looks like so that we can have that kind of before picture, and then I'm going to show you Gusto so we could actually go ahead and like pay this payroll, and then what it'll look like afterwards. So I can basically show you the journal entries that would be made in order to get the books fixed, okay? So we're gonna take a couple steps, but it's gonna be great. And you guys are gonna follow along just fine. We're gonna hop into the financials, and then this situation that I have here that I've concocted for this video is that the owner has paid themselves withdrawals. We're going to reclassify about $40,000 of draws to owner's pay, because right now they've only paid themselves $20,000 on owner's pay, and we really need to get them up higher. We're assuming we've done a reasonable compensation report and it came back that $60,000 for a salary would be reasonable for this business and for the owner and what they're doing. We're going to walk through and make that entry. Okay, so let's hop into the financials right now. So here we are in this example company. I have a profit and loss statement and I have a balance sheet. So we're going to look at both of those. We're going to skip down to the wages area so you can see right here in payroll expense. There is salaries, and then there's an owner's pay of $20,000 here, and then payroll taxes there of $10,000. So those are two of the numbers that are going to change. And then let's just take a peek at the profit right now, where the profit is at $74,000. Now let's take a look at the balance sheet. The checking is at $26,000. And then we have an owner's draw here of $95,000. This is what they've taken during the year. And then retained earnings of $11,000, and then net income is coming over from the profit and loss, okay? So what we're gonna do is we're gonna reclassify some of this owner's draw to reduce the owner's draw and increase the salary up here for the owner, this line right here, okay? So we're gonna make this $60,000. So what I've done here that you will notice later is that I have a copy of this column so that we can see the changes once we make them. But we're gonna hop over to Gusto now. Now that you guys have seen the situation, let's hop over to Gusto and let's make a change for our owner. So here we are in Gusto. And what we're going to do is we're going to run an off-cycle payroll for the CEO of this company, okay? So I have looked into the team members. I know who the CEO is. It's Regina Spector. Really like her. And let's see, let's go over to run payroll. So over on the left-hand side for pay, we're gonna go to run payroll. And so what we're gonna do in this situation is, because this company already has payroll cycles set up, and I don't want to mess up any of that. If that's the case, like you don't want to mess up any of your other payroll, you just want to run this one thing for this one person, you can run a off-cycle payroll. Now, this might be different with a different payroll provider, I will say that. And you should be able to do the same concept with any payroll provider. I'm just using Gusto because, again, this is the demo that I have available to me, and I'm pretty familiar with navigating around Gusto. But you should be able to do something very similar, or at least you could contact support and figure out how you could do a similar thing if you're using a different payroll provider. If you have a payroll account where it's just this one person, then you can actually set up a separate payroll cycle if you want to, but that's not really the purpose of this video. So what I want to do is I'm going to go for an off-cycle payroll, and then I'm going to select the employee that I want to pay. And so that's Regina Spector. And then, really importantly, you need to get the work period correct. So in this situation, I want this to be from 1/1/2024 all the way through, I think I can do it through the end of the year. It should be able to. And then we're gonna do the payment date. I'm just gonna put it at the end of the year, but you probably would wanna do a payment date, you know, a day before the end of the year or whatever. You just wanna make sure that it gets into the account before the end of the year, or gets it all accounted for before the end of the year. And then what we're going to do is we're going to look here at the deductions and contributions. We want the taxes to be taken out. That is the whole point of doing this, is so that we can report those wages to the IRS to say, like, yes, we've paid these wages. We're not actually going to pay out in cash additional wages to the employee. We're just going to basically say, hey, that, $40,000 you took in draws over the course of, 6 months, we're going to call that W-2 wages now, so it'll be showing up on your W-2 when you get it at the end of the year, but we're not going to actually pay you out that extra money. But what we do have to do is we have to pay out money on the payroll taxes for that payroll. So that can be kind of a hefty bill, okay? And I'm going to show you what that looks like. So when you're here, you're going to block deductions and contributions for benefits managed by Gusto, except the 401k. Taxes will still be included. That's what you want to do, okay? And then we'll make all regular deductions and contributions. I think those are usually the two that you would select, okay? So then we're going to go down here. Now, since Regina is paid on a salary, we're not entering in hours here, but if the hours were available and you wanted to put in, like maybe your owner is paid by the hour in Gusto, then like let's say it's $50 an hour, then there would be a place here to put in hours. And the regular hours for a full year of working is 2,080 hours, 2080. And so you would put that in here if you're paying for the whole year, okay? Then what we're going to do in order to like calculate how much we're going to move over. Now, this example of 110 per year does not relate to the financials that we have. We're just going to kind of pretend like this says $60,000 per year, okay? I could have maybe changed it, but I didn't. So we're going to pretend that says $60,000. And so what I'm going to do here, we've already paid this employee $20,000 in W-2 wages. So what I want to do is I want to get her up to $60,000, okay? The CEO. Now the big thing that is very, 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 very important is you do not leave direct deposit on because then your CEO who has already taken draws is going to get another big fat paycheck, and that's not what we want to do. What we want to do is pay this by check. So you're going to say to Gusto, hey, or your payroll provider, hey, yeah, I'm going to write a check to that employee. But the thing is that you've already written checks. Those draws have already been taken. So you're not going to physically write a check here. So just make sure that's really, really clear. I will show you the journal entries that you need to do later to fix that. But you are not going to write a check. Got it? You are just saying that you're going to write the check. And this is totally okay, just so you know. This is how you're supposed to do it. All right, let's go to save and continue. And so now we're going to skip over PTO hours because we're not doing that. Now it's going to show us a summary. I really like this tax breakdown summary. Okay, so we're going to go back and look at the taxes breakdown here so that we will show what the journal entries will look like when they go into the financial statements. So I just want to kind of show this to you guys. These employee taxes, so normally these would have been taken out of a paycheck, but the way that we've set it up this time is that we are assuming that the company is going to be, basically paying this out of pocket for the employee this time around. Now, there are ways to change the withholding and reduce it in Gusto. I don't have the ability to show you in my demo account. So you can offset and take out this federal income tax withholding if you do not want it. Let's say you've been paying estimated tax payments throughout the year. Then if that's the case, you might not need to also pay this federal income tax. So you might not need to do that, but you, again, like with California state income tax, if you've been paying estimated state taxes, you could probably remove this off of the list. Now, if you're using a different payroll provider, they probably have other ways to adjust withholdings. And then if you really need help, you can always contact support to get your withholdings correct before you run the payroll, okay? FYI, what this is showing right now is that we're gonna take out $21,000 plus the $3,000 and pay all of that in as the employee's portion has been withheld, and then also the employer's portion. So all of that's going to come out of the bank account. Now, what you might want to do with the owner is say, hey, if you're the accountant and you're trying to do this right, or you're the bookkeeper and you're trying to do this right, and they might need to pay the company back for some of this taxes. So that might be a way to sort of like offset the owner's draw, but I'm going to show you what this looks like in the journal entries. Okay, so just keep these numbers in mind, and you would have submitted payroll. We're going to go over we're going to hop into the financials here. So what that would look like, I'm going to show you some journal entries. So if you were really to be writing a check to your employee, like that payroll that we just processed for Regina Spector, this is the journal entry that would basically come through. There would be a debit to owner's pay, which increases owner's pay because that's an expense, and a debit and increases expenses. And then a debit to payroll taxes. So these two numbers, let's go ahead and change those on our profit and loss. So changed them here. I've got 60,000, it was 20,000, so I added 40, and then I added the 3060. So those numbers have been added. Here's our change column over here. You can see that really clearly. So it's increased our payroll expenses and increased or decreased profit. And then the other side of that would be the taxes going out, the withholding and the company taxes are going out of the bank account. So we need to make that adjustment. Now, this would be a really hard thing for this business owner to afford at this point in time because they don't have much more than what is coming out of the account right now. This makes me nervous. I would be having a serious conversation with the owner and being like, you need to pay up in order to help afford all those withholdings, because the business is basically paying for the withholdings in this situation. So we would not really be great about that. So we would be adjusting that. Now, if they were actually paying a check, this journal entry as it comes through, if they were actually paying a check, that check for $18,885, which is the difference, would also be coming out of the bank account whenever the owner was paying it. But because we are not actually paying with a check, we are going to change that journal entry when it comes through, and that would be this journal entry down here, and change that account to owner's draw. So what that does is it decreases the owner's draw by 18, which I have to add it here, 18,885.27. Okay, so you'll see there's that difference here. And so I'm going to double check and make sure my balance sheet is balanced. Total assets equal total liabilities and equity. Okay, so that's the net effect. So the CFO in me is going, well, we need to do something about this because now our cash is like really low. What I would recommend is actually having the owner in this situation refund or fund back into the business what was considered their withholding here. So going back to that Gusto amount, I'm going to show you guys that. This employer taxes, the federal income taxes, really all of this side. If the business owner could afford it, I would have them put this $21,000 back into the business. And then if that were the case, the journal entry would be, the debit would be to the increase to the cash account. Credit, owner's draw. And then if we did that, that would be a contribution. So it would be reducing the owner's draw. And it would be putting cash back into the business. So that is what it would look like if the business funded, if the business holder funded the withholdings, which really they should, because if they were to be taking a normal paycheck, that's what should be happening. And so then basically our owner's draw is about $55,000 for the year instead of the $95,000 that it was, would represent that $40,000 that we reclassed. So this would need to be cash coming back into the business from the business owner. Okay, so I hope that that clarifies things a little bit for you guys. I know that this is a little bit tricky, not the easiest thing to do, but I wanted you guys to know how to do it so that you are very clear. And let me know if you have any questions in the comment section below. And if you're looking for a payroll solution for your small business, or if you are a solo S-Corp owner, definitely check out Gusto. Go to claracfo.com/Gusto. All right, thanks so much. Bye, everybody.